traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about a powerful strategy that can significantly enhance your day trading performance. The Stochastic RSI day trading strategy. This approach combines two popular indicators to provide a more accurate view of the market momentum and potential reversal. By mastering this strategy, you can improve the ability to identify profitable trades and avoid costly mistakes. So stay tuned until the end of this video to learn how to effectively integrate the Stochastic RSI into your trading routine and take your day trading to the next level. Now, what is the Stochastic RSI? The Stoch RSI is a technical analysis tool that combine the strength of the RSI, which is the relative strength index, and the stochastic oscillator. It was developed by Stanley Stoch and Toshan Chad in 1994. These new technical traders, with the aim of providing more sensitive signals for overbought and oversold condition. So let's see how we can trade using the Stochastic RSI for day trading strategy. First of all, you set up your chart. You begin by setting up your chart with the Stochastic RSI indicator, which you can see on my screen. This indicator is most effective on shorter time frames, such as your 15 minutes time frame or your 1 hour time frame, which are ideal for day trading. Additionally, you can add a simple moving average of 180 period to help you identify the overall trend or direction of the market. So adding my simple moving average with a length of 180 to the chart. The second step is to identify the trend using the 180 simple moving average as a trend filter. If price is consecutively above the simple moving average, this indicates that we are in an uptrend. But when price is below the simple moving average, this suggests that we are in a downtrend. So when price is above the simple moving average, the 180 period moving average, we are in an uptrend. Consecutively or conversely, when price is below the simple moving average, we are in a downtrend. This is basically what it means. The next step is to always wait to monitor your stochastic oscillator, your Stochastic RSI oscillator, for signals that align with the trend. So for long positions, you wait for the Stochastic RSI to rise from the oversold zone, which is the 20 region. When price is around the 20 region on your Stochastic RSI indicator, once price is above that, we are expecting price to leave that oversold region to go to to head to the overbought region. So for long position, if I'm to take a long trade, we wait for this Stochastic RSI to rise from an oversold region, which is the 20 region. Once we notice price is above there, this is where we would want to capitalize and enter our long position. Remember, price has to be above your simple moving average. Now, when price is below your simple moving average, you look for price at the Stochastic RSI to fall below your overbought region, which is you wait for price to fall below your 80 region. When price begins to fall below your 80 region, that signals an opportunity for you to enter a short position. You can also, the fourth step is to confirm using price action. Before entering your trade, you have to confirm the signal with price action. For a long position, you wait for a candle to close above the previous high after the stochastic signal. So once price closes above this previous high, you can see there's a previous high in this area. If I mark this area, this is my previous high. Price has broken above this previous high and closed above the previous high. This signifies that price is ready to go to the upside after we have indicated price have left the oversold region above the 20. This is where we would want to enter at this area. For a short position, after confirming that price is below the simple moving average, you wait for your stochastic RSI to fall from the overbought zone, and when price falls from the overbought zone, which is from the 80 region on this stochastic RSI, this is where you would want to enter the trade after you see a candle close below the previous low. In this area, this is the previous low. Once price has closed below the previous low, in this area, this is where you want to enter your sell position after we have gotten our confirmation from our stochastic RSI. Where do we set our stop loss and take profit? We set our stop loss and take profit. You place your stop loss above the nearest swing high for a short position. You set it above the nearest swing high for a short position. And for a long position, you set it below the nearest swing low. Set this below the nearest swing low for your long position. Then for your take profit, you use a fixed risk to reward of 1:2 for your take profit level. 1:2 should be a fixed risk to reward ratio point for your trade. 1:2. This will help you capitalize on the market potential. 1:2 in and out the trade. You also need to know how to manage your risks. Always manage your risks by not risking more than 1 or 2% of your trading account on a single trade. Always risk at least 1 or 2% of your trading account on a single trade, not more than that. Or you can also consider using a trading stop to lock in profits as price moves in your direction, in favor of your direction. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you would never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.